Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. I think we saw some weakness in the market, but we've got more data to show you that an even bigger fall could be ahead of us, and we're going to tell you exactly where that can come from. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening. The Wall Street Journal today had a really interesting article about real estate, something that most people aren't talking about. You were mentioning to me that said, offline, a lot of people think everything's fine and dandy in real estate because we have basically a Mexican standoff now between buyer and sellers because of fixed rate loans. But that's not how markets work. Not like the stock market and not like the real estate market. The marginal buyer and the marginal seller sets the price. And we have a lot of people that have bought real estate in these, I guess we would call these, like, you call them private REITs. That's a good way of putting them. They're called syndications where, for example, if you and I, Phil, wanted to buy a portfolio of real estate, but we don't have enough money, but we agreed to manage the property and manage the reservations and the maintenance. And we said, we don't have enough money and we don't want to go to a bank and get a loan because they're not going to give us as good a deal, is that we would go to our friends and family or go out on social media, and there's a legal construct to be able to create these syndications. And probably the one that most people know is like Grant Cardone and what he does. He's really active in social media. And so you get a bunch of people that are newbies that don't know anything about real estate, but they flash this, hey, risk-free real estate, is really, it's collateralized. You're going to get 7%. Where are you going to get 7% on your money? And then lo and behold, you're getting 5.5% treasury bill money and your 1% one year floating rate mortgage is now sitting at 7%. And oh, by the way, rents are starting to soften, and people that are in these Airbnb superhost kind of situations now are seeing less people take vacation, yada, yada, yada. Long story short, a disaster is coming. And Phil, I want to kind of throw it back to you because, you want to kind of give a really good example of what happened there.
Yeah, so in that article, Bob, they talked about this one guy. He's a tech worker, Indian guy, immigrant, came in and started figuring out that, hey, I could start doing this too. They relaxed the rules in 2012 about these like real estate investment clubs. And so essentially what you have is you're able to kind of create your own REIT. You can buy REITs in the stock market, right? Just like a stock. But in this one, you can actually just go direct more or less. And the upside is you have better returns. Well, so what they've done is they've basically gone crazy in recruiting investors, and what the problem here, like you mentioned, is that they're using floating rates. So much like the banks that blew up, the sudden rise in rates has started to take its toll. This guy lost more than 3,000 apartments across 4 rental complexes. And so this particular example is one of the larger real estate blowups since the great financial crisis. And I think this is the tip of the iceberg. Most of the time, if you talk to people that have been around the block a few times, a few interest rate cycles, they'll tell you that the pace in which the Fed has raised rates usually breaks something, right? And we haven't really seen things really break yet. You could say, yeah, 2022 is rough on the stock market, but honestly, in the last few months, what have we done? We've gone sideways. We're talking about like when things really break, things are going belly up and the market's down week after week after week, and it just feels like it's never going to end. That's when you start breaking things. And I don't think we've seen it yet, though I think we're seeing these shots across the bows so to speak. And the problem with this is that he's not the only one, right? And like you mentioned, there's the Grant Cardones in the world and things like that. This is a big business. I mean, there's billions and billions and billions of dollars. He's just one example. But if he's blowing up, you can rest assured more people are blowing up. And I think that's what really kicks off the bear market in the real estate, Bob. And like anything else, once the fire starts in one corner of the forest, it usually spreads. And so while you may have a situation where, yeah, we do have a lot of people that bought homes and, they are sitting on 2-3% mortgages, but that's one slice of the real estate pie. You have people that have Airbnbs that rely on, positive cash flow. You and I both know the Airbnb market is in a lot of trouble. And so you got all these various elements that are going to cause some forced selling to take place, and it's going to create issues in the stock market. It's going to create issues in the real estate market with comps. Comps are really important in a real estate market. If all your comps start dropping, some properties that you may have collateralized, their loan to value ratio gets screwed up, and that causes other issues. So, it can get a little complex in the relationships. Bottom line is, though, this is the start of what can really kick off a lot of weakness across the board in not only real estate, but also the stock market.
Yeah, and let me tell you guys, you would think that you were part of the collateral pool, but I guarantee you, when this is all said and done, there are going to be investors that found out that they were just participating in the rental pool, if you will, but these guys went ahead and leveraged other properties using that as collateral that actually will get foreclosed upon, and you end up with nothing. I'm willing to bet you $1,000, Phil, when this thing's all said and done in a couple of years, we're going to see those kind of headlines out there, how people basically defraud it and lose everything. I'll give you an example. And you think, hey, only these dumbasses do it. Well, I figure I'm a pretty sophisticated guy, and myself and 2 other guys went ahead and helped a guy secure a property that he was going to flip into a 90-day SBA loan. Okay. And I'll just give you the details. We were going to get 12% on our money. Okay. And it was 90 days, all fees, and double collateralized. Feels like a no-brainer deal. Okay. Well, this was in 2006. That SBA loan, he ended up not getting the qualifications for it. Okay. And then I got out of that loan, Phil, in 2018. Okay. My 12% interest on that loan became 6%, and probably the net APR on that thing, or APY, whatever, is probably 2 or 3%, because we did everything we could to get our collateral back because it was touch and go for him. We were lucky. In 2008, 2009, that property became less than 100% collateralized. He could have told us to go pound sand, but he was an honorable person, and we just worked it through together. Okay. That was a 12-year, 90-day loan. And you're going to see a lot of people in these situations, okay, that are going to come up. The other thing that people don't realize, these guys were fee monsters doing these things, okay? Guys like Grant Cardone don't fly around in a private jet because he's let as he is, okay? They suck fees out on the front end. They got other corporations that are handling the maintenance, handling the reservations, handling the bookings. Those guys, just like private equity companies, they get their money out first and fast, okay? And at the end of the day, when those properties get distributed, then you get your money back, or they find new people to plug into the matrix as you go along. But when you get a situation like now, Phil, you're going to find out that you're locked in. You are now a long-term investor in a project that may end up losing money over time. So your money's locked out. So people are doing this stuff because they thought it was, hey, I'm getting their retirement, real estate, how risky can it be? It's a REIT, la-da-da. Well, guess what? Blackstone's gating, okay? BlackRock's gating. What gating means that they're just putting a gate up so you can't get your money out. So it's going to be a big, big problem. And as it rolls and the snowballs, this is going to be worse than 2008, Phil, just because you're not going to get the revenue on the back end, and there's not going to be the people that are going to be able to buy these properties. And this time, the institutions are getting hammered too. 2008, it was more on the retail side. So there's not going to be anybody backstopping these guys to take the product off their hands. So it's going to be a big, big mess. And when this gets locked down, people say to me, Bob, hey, things are going well. The rich are doing fine. They're going to still spend. Well, nothing like curing rich spending by finding out that 30% of your portfolio that you were getting 7 and 8% on is now gated. Oh, by the way, we're not sure we can pay you this month or this quarter because we're losing money. Well, then all of a sudden you get scared and you start pulling back in other areas. And that's how you go off a cliff.
Yeah, and that's where the rush to the exits in the burning movie theater, right? That's that's how that all starts, and that's where the market drops really, really quickly and erases a lot of that easy money gain that we saw. I mean, this is not a small slice of the pie here. $115 billion was raised between 2020 and 2022 here, according to the Wall Street Journal. I mean, that was the peak of what our free money, right? So I think easy come, easy go situation here, Bob, and you just have to be really careful, especially if you got exposure to this stuff. You got to be very, very careful. Even the REITs in the stock market, you know, the stuff that's under the scrutiny of the regulators, I think you have to be very careful in this environment. I would not be long much real estate at all. I don't, especially commercial, but even I think some of these multi-family dwelling investments are just toast here, and you're going to be able to step away, let everything just burn down, and you can come pick up the pieces like these guys do. You know, the Grant Cardones of the world, they're not stupid. You know, they'll be selling to you right at the very end. Meanwhile, they're packing up and going into sabbatical, waiting for the floor to drop out. You know, Kiyosaki's another one of those guys. You know, he loves to come in. He's very good at timing markets. He loves to come in when it's just, you know, blood in the streets, and that's how these guys really build their wealths. And so you can too. You just can't be buying when these guys are exiting, and doing so you can make multiples over this market. But timing's very key.
Yeah, and I think this is what Powell had in mind. Why risk getting 7% in a REIT when you get 5.5% 90-day money that you could continually roll?
Right.
And I think that's what he's trying to do, is trying to show everybody, you know, and the banks too, you know, don't take these people's deposits and then be in Wall Street doing stuff. And eventually he'll be vindicated, you know, as much as I hate central banks, but he'll actually be vindicated because he's going to stabilize, you know, the markets after he gets it corrected down to normalized levels. Or look, we want to have a society, you know, with your kids and my kids, they want to buy a house someday. You know, they don't want to sit there and be like Europe and you're going to be a renter your entire life. You know, that's not how America works. And you know, you're going to have to bring these prices down. I think demographics and economic situation, real estate's going to be a poor investment for the next 10 to 20 years. Mark my words.
100% agree. Yeah. So a lot of things lining up bearishly for the markets. Speaking of the markets, you know, today we finally had a drop. We've been in that holding pattern. We'd be remiss not to comment on that. Now, is this the big sell we're looking for? Bob, I don't know. I think, you know, the big sell, I mean, we could definitely bleed down into some sort of debt ceiling resolution. I don't think things get really dicey though until we start cracking below 4,100 on SPX myself. And even then you've probably got a safety net at SPX 4,000. I mean, yeah, that's a couple thousand point drop in the Dow Jones Industrial Average as an equivalent measure. But I think once we do get that debt ceiling resolution, I think we are probably looking for a little bit of a pop here. But I do think that's a selling opportunity for reasons we've pounded on previous videos. So, you know, that's my take. I don't know if you feel the same way, Bob, but I just think that this can only go on for so long holding the market up when everything else underneath the hood is starting to just completely, you know, come apart.
The minute Janet Yellen has to stop spending on certain areas, the market's going to come off hard. These are 4 other times this has happened. The dollar has gone up, bonds have gone up, and the market has cratered. So if they can't work this out in the next 7 to 10 days, and then once they work it out, we've already discussed ad nauseum why that's not good for the market. So, but one thing I will say though, I'm going to plug your indicator, Phil. Tomorrow we're just going to show you guys, unless the market has something really interesting for you, we're going to show you this Fed liquidity tool that Phil finally has it ready for sale. And, I loaded up puts on it when it gave a signal. We're still risk on, believe it or not, but it spiked into what we call the short hedging range. And it just makes financial sense when we back look at the data to write puts when it gets in that zone. And then there's a buy area where you write calls, and then you get more aggressive when both those are in tune with each other. We're going to walk you through that tomorrow. You know, I think you'll like it, even though it's a sales pitch. Really cool. And this is the way you need to trade on the right side of the trade. And so watch for it tomorrow. And what we're going to charge for it is nothing compared to what you're going to get out of it. And I think you guys will like it. So bear with us and check us out tomorrow.
All right, guys. Well, that's going to do it for this episode. Appreciate all the likes and subscribes. And if you can pound that notification bell and set it to all, that really helps as well. And like Bob said, we'll catch you on tomorrow's video. Thanks for watching. Take care, guys. Bye-bye.
Bye.
Trade Genius.